So today I'll be discussing something which I have spent years trying to learn, and yet I don't claim to have fully understood it. It's a something of an enigma, and before we get on to the talk, we have a short video of 15 minutes which is very relevant to what I am going to talk about later on. So we'll first play the video and then I'll get on with the subject matter for today. Anil?
Irrational behavior, not yours, of course, other people's. After being at MIT for a few years, I realized that writing academic papers is not that exciting. I don't know how many of those you read, but it's not fun to read and often not fun to write, even worse to write. So I decided to try and write something more fun. And I came up with an idea that I would write a cookbook. And the title for my cookbook was going to be Dining Without Crumbs, The Art of Eating Over the Sink. And it was going to be a look at life through the kitchen. And I was quite excited about this. I was going to talk about a little bit about research, a little bit about the kitchen. We do so much in the kitchen, I thought this would be interesting. And I wrote a couple of chapters and I took it to MIT Press and they said, cute but not for us, go and find somebody else. I tried other people and everybody said the same thing, cute, not for us. Until somebody said, look, if you're serious about this, you first have to write a book about your research. You have to publish something, and then you'll get the opportunity to write something else. If you really want to do it, you have to do it. So I said, I really don't want to write about my research. I do this all day long. I want to write something else, something a bit more free, less constrained. And this person was very forceful and said, look, that's the only way you'll ever do it. So I said, okay, if I have to do it, I had a sabbatical. I said, I'll write about my research if there's no other way, and then I'll get to do my cookbook. So I wrote a book on my research, and it turns out to be quite fun in two ways. First of all, I enjoyed writing, but the more interesting thing was that I started learning from people. It's a fantastic time to write because there's so much feedback you can get from people. People write me about their personal experience and about their examples and what they disagree and nuances. And even being here, the last few days I've known really heights of obsessive behavior I never thought about, which I think is just fascinating. I want to tell you a little bit about irrational behavior, and I want to start by giving you some examples of visual illusion as a metaphor for rationality. So think about these two tables, and you must have seen this illusion. If I ask you what's longer, the vertical line on the table on the left, or the horizontal line on the table on the right, which one seems longer? Can anybody see anything but the left one being longer? No, right? It's impossible. But the nice thing about visual illusion is we can easily demonstrate mistakes. So I can put some lines on, doesn't help. I can animate the lines, and to the extent you believe me I didn't shrink the lines, which I didn't, I've proven to you that your eyes were deceiving you. Now, the interesting thing about this is when I take the lines away, it's as if you haven't learned anything in the last minute. You can't look at this and say, okay, now I see reality as it is, right? It's impossible to overcome this sense that this is indeed longer. Our intuition is really fooling us in a repeatable, predictable, consistent way. There's almost nothing we can do about it aside from taking a ruler and starting to measure it. Here's another one. This is one of my favorite illusions. What do you see the color that the top arrow is pointing to? Brown, thank you. The bottom one, yellow. Turns out they're identical. Can anybody see them as identical? Very, very hard. I can cover the rest of the cube up, and if I cover the rest of the cube, you can see that they're identical. And if you don't believe me, you can get the slide later and do some arts and crafts and see that they're identical. But again, it's the same story, that if we take the background away, the illusion comes back, right? there's no way for us not to see this illusion. I guess maybe if you're colorblind, I don't think you can see that. I want you to think about illusion as a metaphor. You know, vision is one of the best things we do. We have a huge part of our brain dedicated to vision, bigger than dedicated to anything else. We do more vision, more hours of the day than we do anything else. And we're evolutionarily designed to do vision. And if we have these predictable, repeatable mistakes in vision, which we're so good at, what's the chance that we don't make even more mistakes in something we're not as good at? For example, financial decision making. Something we don't have an evolutionary reason to do, we don't have a specialized part of the brain, and we don't do that many hours of the day. And the argument is that on those cases, it might be the issue that we actually make many more mistakes. And worse, not have an easy way to see them. Because in visual illusions, we can easily demonstrate the mistakes. In cognitive illusion, it's much, much harder to demonstrate to people the mistakes. So I want to show you some cognitive illusion, or decision-making illusion in the same way. This is one of my favorite plots in social sciences. It's from a paper by Johnson and Goldstein. And it basically shows the percentage of people who indicate that they would be interested in giving their organs to donation. And these are different countries in Europe, and you basically see two types of countries. Countries on the right that seems to be giving a lot, and countries on the left that seems to be giving very little, or much less. The question is why? Why do some countries give a lot and some countries give a little? When you ask people this question, they usually think that it has to be something about culture. Right? How much do you care about people? Giving your organs to somebody else is probably about how much you care about society, how linked you are. Or maybe it is about religion. But if you look at this plot, you could see that countries that we think about as very similar actually exhibit very different behavior. For example, Sweden is all the way on the right, and Denmark, that we think is culturally very similar, is all the way on the left. Germany is on the left, and Austria is on the right. The Netherlands is on the left, and Belgium is on the right. And finally, depending on your particular version of European similarity, you can think about the UK and France as either similar culturally or not. But it turns out that from organ donation, they're very different. By the way, the Netherlands is an interesting story. You see, the Netherlands is kind of the biggest of the small group. Turns out that they got to 28% after mailing every household in the country a letter begging people to join this organ donation program. Right, so you know the expression, begging only gets you so far? It's 28% in organ donation. But whatever the countries on the right are doing, they're doing a much better job than begging. So what are they doing? Turns out the secret has to do with the form at the DMV. And here's the story. The countries on the left have a form at the DMV that looks something like this. Check the box below if you want to participate in the organ donor program. And what happens? People don't check and they don't join. The countries on the right, the ones that give a lot, have a slightly different form. It says, check the box below if you don't want to participate. Interestingly enough, when people get this, they again don't check, but now they join the program. Now, think about what this means. You know, we wake up in the morning and we feel we make decisions. We wake up in the morning and we open the closet and we feel that we decide what to wear, and we open the refrigerator and we feel that we decide what to eat. And what this is actually saying that much of these decisions are not residing within us. They're residing by the person who's designing that form. When you walk into the DMV, the person who designed the form will have a huge influence on what you'll end up doing. Now, it's also very hard to intuit these results. Think about it for yourself. How many of you believe that if you went to renew your license tomorrow and you went to the DMV and you would encounter one of these forms, that would actually change your own behavior? Very, very hard to think that it will influence us, right? We can say, oh, these funny Europeans, of course it would influence them. But when it comes to us, we have such a feeling that we're in the driver's seat. We have such a feeling that we're in control and we are making the decision that it's very hard to even accept the idea that we actually have an illusion of making a decision rather than actual decision. Now, you might say, you know, these are decisions we don't care about. In fact, by definition, these are decisions about something that will happen to us after we die. How could we care about something less than something that happens after we die? So a standard economist, somebody who believes in rationality, would say, you know what? The cost of lifting the pencil and marking a V is higher than the possible benefit of the decision, so that's why we get this effect. But in fact, It's not because it's easy, it's not because it's trivial, it's not because we don't care, it's the opposite. It's because we care, it's difficult and it's complex, and it's so complex that we don't know what to do. And because we have no idea what to do, we just pick whatever it was chosen for us. I'll give you one more example for this. This is from a paper by Redelman and Shafir. And they said, would this effect also happens to experts? People who are well paid, experts in their decisions, do it a lot. And they basically took a group of physicians and they presented to them a case study of a patient. And they said, here's a patient, he's a 67-year-old farmer, he's been suffering from a right hip pain for a while. And then they said to the physician, yes, you decided a few weeks ago that nothing is working for this patient. All these medications, nothing seems to be working, so you refer the patient to hip replacement therapy. Okay, hip replacement, okay? So the patient is on a path to have his hip replaced. And then they said, half the physicians said, yesterday, you review the patient's case and you realize that you forgot to try one medication. You did not try ibuprofen. What do? Do you pull the patient back and try ibuprofen, or do you let them go and have hip replacement? Well, the good news is that most physicians in this case decided to pull the patient and try ibuprofen. Very good for the physicians. The other group of the physicians, they said, yesterday when you reviewed the case, you discovered there were two medications you didn't try out yet. Ibuprofen and piroxicam. They said, you have two medications you didn't try out yet. What do? You let them go, or you pull them back. And if you pull them back, you try ibuprofen or piroxicam. Which one? Now, think of it. This decision makes it as easy to let the patient continue with hip replacement, but pulling them back all of a sudden becomes more complex. There's one more decision. What happens now? Majority of the physicians now choose to let the patient go to hip replacement. I hope this worries you, by the way, when you go to see your physician. The thing is that no physician would ever say piroxicam, ibuprofen, hip replacement, let's go for hip replacement. But the moment you set this as the default, it has a huge power on whatever people end up doing. I'll give you a couple of more examples of irrational decision making. Imagine I give you a choice. You want to go for a weekend to Rome, all expenses paid, hotel, transportation, food, breakfast, a continental breakfast, everything, or a weekend in Paris. Now, weekend in Paris, weekend in Rome, these are different things. They have different food, different culture, different art. Now, imagine I added a choice to the set that nobody wanted. Imagine I said a weekend in Rome, a weekend in Paris, or having your car stolen. Now, it's a funny idea, because why would having your car stolen in this set influence anything? But what if the option to have your car stolen was not exactly like this? What if it was a trip to Rome, all expenses paid, transportation, breakfast, but doesn't include coffee in the morning? If you want coffee, you have to pay for it yourself. It's €2.50. Now, in some ways, given that you can have Rome with coffee, why would you possibly want Rome without coffee? It's like having a car stolen. It's an inferior option. But guess what happened? The moment you add Rome without coffee, Rome with coffee become more popular, and people choose it. The fact that you have Rome without coffee makes Rome with coffee look superior, and not just to Rome without coffee, even superior to Paris. Here are two examples of this principle. This was an ad from The Economist a few years ago that gave us three choices. An online subscription for $59, a print subscription for $125, or you could get both for $125. Now, I looked at this and I called up The Economist and I tried to figure out what were they thinking. And they passed me from one person to another, until eventually I got to a person who was in charge of the website, and I called them up and they went to check what was going on, and the next thing I know, the ad is gone and no explanation. So I decided to do the experiment that I would have loved The Economist to do with me. I took this and I gave it to 100 MIT students. I said, what would you choose? And these are the market share. Most people wanted the combo deal. Thankfully, nobody wanted the dominated option. That means our students can read. But now, if you have an option that nobody wants, you take it off, right? So I printed another version of this when I eliminated the middle option, and I gave it to another 100 students. Here's what happens. Now the most popular option became the least popular, and the least popular became the most popular. What was happening is that option that was useless in the middle was useless in a sense that nobody wanted it. but it wasn't useless in the sense that it helped people figure out what they wanted. In fact, relative to the option in the middle, which was get only the print for 125, the print and web for 125 looked like a fantastic deal. And as a consequence, people chose it. The general idea here, by the way, is that we actually don't know our preferences that well. And because we don't know our preferences that well, we're susceptible to all of these influences from the external forces, the defaults, the particular options that are presented to us, and so on. One more example of this, people believe that when we deal with physical attraction, we see somebody and we know immediately whether we like them or not, attracted or not. This is why we have these 4-minute dates. So I decided to do this experiment with people. I'll show you graphic images of people, not real people. The experiment was with people. I showed some people a picture of Tom and a picture of Jerry, and I said, who do you want to date, Tom or Jerry? But for half the people, I added an ugly version of Jerry. I took Photoshop and I made Jerry slightly less attractive. The other people, I added an ugly version of Tom. And the question was, will ugly Jerry and ugly Tom help the respective more attractive brothers? And the answer was absolutely yes. When ugly Jerry was around, Jerry was popular. When ugly Tom was around, Tom was popular. This, of course, has two very clear implications for life in general. If you ever go bar hopping, who do you want to take with you? You want a slightly uglier version of yourself. Similar but slightly uglier. And the second point, of course, is that if somebody else invites you, you know how they think about you. What is the general point? The general point is that when we think about economics, we have this beautiful view of human nature. You know, what a piece of work is man, how noble in reason. We have this view of ourselves, of others. The behavioral economics perspective is slightly less generous to people. In fact, in medical terms, that's our view. But there is a silver lining. And the silver lining is, I think, kind of the reason that behavioral economics is interesting and exciting. You know, are we Superman or are we Homer Simpson? When it comes to building the physical world, we kind of understand our limitations. We build steps and we build these things that not everybody can use, obviously, but we build them. We understand our limitations and we build around it. But for some reason, when it comes to the mental world, when we design things like healthcare and retirement and stock markets, we somehow forget the idea that we're limited. And I think if we understood our cognitive limitations in the same way that we understand our physical limitations, even if they don't stare us in the face in the same way, we could design a better world. And that, I think, is the hope of this thing. Thank you very much.
Was that interesting?
Yeah.
Interesting. I had a choice. I could have put only a part of this, which is relevant to the subject today, but I felt it would have taken away from the charm of the whole talk. So we saw optical illusions, those two tables and that color on the Rubik's Cube and all of that. So what I am going to talk about today is illusions in the financial markets or in the stock market. See, there is a little bit of mathematics involved today. So no higher order mathematics, some division and multiplication and all. Even if you don't get a portion of it, you will grasp the gist of what I am talking about. So if one or two slides you don't understand somewhere in between, don't worry. And if you have questions, of course, I will be happy to take those questions. So this was one of the sessions I took for investment professionals at the Flame University. So that same topic we are discussing today. Let us go with a thought experiment. We have two companies, almost identical. So you have company A, company B. The names are not relevant. So you have two companies. Both companies have the same earning per share. And both companies are expected to grow at the rate of 12% per annum to eternity. That is a given. So there is no ambiguity about that. So how would we value these companies? Should both companies have the same price? Should both companies have different prices? What should be the case?
Look at other variables also. Currently same.
Currently same? Okay. You are saying
Look at other variables.
you are saying other variables. What other variable can you?
Total size, segment of the business.
Size, how does that matter? So as long
Is a 1 crore company or a 100 crore company?
you are buying one share at 100. So whether company A has a turnover of 100 crores and this has a turnover of 1 crore.
The risk of your investment.
Risk, I am saying there is no risk. All these are, I am signing on a stamp paper and giving it to you. These things will happen.
Depends on what business each one is doing.
How does that matter?
Because if I may get more than 12.
No, it won't be 12 and a half, it won't be 11 and a half. I am guaranteeing that to you. Management, they will not take your money and run away. In fact, I will even say the same management could be promoter of both companies. I will even give that to you.
You said the name is not important actually.
So what industry is not important?
Industry, if you are saying it could be important, it may not be important. But why should industry be important? You are buying one share at 100.
One might be a industry which is going down and one might be.
It's not going down. You will grow at 12%
But he's telling you.
No, but you
to
see
eternity.
in the market which is perception of that industry.
If, let's say there is no market, there is no stock market. These are both unlisted companies. It's a private equity business opportunity that you have. You cannot sell it. You can just depend on the profitability of the company.
Like alphabet A.
Sorry.
Put money in both the companies. Because I like alphabet A.
Okay, so it's a flip of a coin basically, or other preference. Okay.
As you said, name is not
But
important.
one more variable could be if there is a probability of higher returns, more than 12.
That's what I said.
I am saying that there is no probability. There is no probability. It's a thought experiment. So you will argue how can it be possible and all that. I am saying there is no probability like that. They are equal. So this was the question. Almost everyone has said equal. So I was expecting a split house. But now I'll tell you this. Company A trades at a price of 3,333. Company B trades at 833 rupees. So 100 is the earning per share. So price divided by earning per share, P ratio. 33 for company A, 8.33 for company B, which is the overvalued company here. A is the overvalued company. Everyone agrees? It's exactly this. Which table is longer? This table is longer. If you want to actually come and measure it, you have an opportunity. Keep a piece of paper, measure this way, both are equal. Under certain circumstances, both the companies could be fairly valued. Now, this is the financial illusion that I was talking about. A price earning ratio of 8 always seems cheap. A price earning ratio of 30, 35 always seems expensive. And just like in the talk by Dan Ariely, where he said that the moment you take away the ruler and the lines, your mind again starts playing tricks with you. You know both are equal, but still your eyes tell you that the one on the left is longer. Similarly, I know the thing that I am going to talk to you, and I'll hopefully try and prove that both are fairly valued. But despite knowing that, when in real life I look at stocks and some stock is available at 30 times earnings, I find it difficult to buy that stock. I may be tempted to sell a stock like that if I am already owning it, and a stock which is at 8 times earnings will always appear cheaper to me. So essentially I am arguing that you could have a case where both companies are fairly valued or equally valued at these prices. So far we have spoken about earnings per share, we have spoken about growth in earnings per share. People talk about price earning ratios, and some people talk about what is called PEG ratio, which is some recent invention. People divide the price earning ratio by the growth rate. So in this case, they would divide 33 by 12 to come to a PEG ratio. In the second case, they will divide 8 by 12. So they will say company A is expensive on a PEG basis and company B is cheap on a PEG basis. They completely ignore these things: capital intensity, return on equity, and dividend payout ratios. So when I asked you what are the factors you would consider, you said, oh, growth rate could be different, but despite harping on these ratios for last maybe 2 or 3 years, we did not consider these ratios: the capital intensity, return on equity, and payout ratio. Essentially, these three combine to only one ratio, but that is a slightly technical aspect. We will see why these are relevant. Now I am giving you some additional information relating to both these companies. Okay, before we get to the additional information, how do we value a equity share? Or how do we value a bond? Or how do we value a real estate that we own? See, essentially in investing, there is only one thing: how much money are you putting today and how much money you will get on that investment in the future. The two things you have to compare at one point in time by either discounting or compounding, and then see which one makes more sense. So there is only one formula for all of these. There is no formula beyond this one formula, which is amount after a certain number of years equal to principal into 1 plus r raised to the number of years. The compound interest formula that we learnt in high school. Okay, I am now giving you additional information. In both companies, A and B, your expected return is 15%. You want 15% return by investing in that company. Company A is, someone said, industry. Industry could be relevant, but you are not able to explain why industry would be relevant. Industry would be relevant from the capital intensity or return on equity point of view. So if company A is a company like, let's say, CRISIL or ICRA, or let's say Hindustan Unilever or a Nestle or something, where they have negative working capital, their distributors give them advances and they buy on credit from their suppliers, and effectively their whole manufacturing facility is funded by that. Or in the case of rating agencies, there is no plant that they have to put up. They can rent out some premises give appointment letters to some chartered accountants or MBAs and get into the rating business. So they can grow at 12% without deploying any capital. As compared to that, company B could be a utility company. Let's say it's a power generating company. Now for a power company to grow at 12%, they have to set up more and more capacity each year, sell more power and generate more returns. Or it could be a cement company, steel company, whatever. On a sustainable basis, if they want to grow, they have to deploy additional capital in their facilities. So this company, which has a EPS of 100, can have a dividend per share of 100. They can pay out all their profits and grow. This company, if it has a EPS of 100 today and it wants to generate a EPS of 112 next year to sustain that 12% growth, it has to keep back 75 rupees, deploy that at 16% to generate that additional 12 rupees next year. So this company can grow at 12% only by retaining 75% of its profits. This company will pay only 25 rupees as dividends. So we saw the compound interest formula is this. If you want to value an equity share, you have to take the dividend after 1 year, discount that by 1 plus R. Dividend after 2 years, discount that by 1 plus R square, and so on to eternity. This is the formula to value an equity share. Nothing complicated. This is the high school formula, the compound interest formula that we saw. Now, it would involve a lot of calculations. Luckily for us, wherever growth is constant and wherever required rate of return is constant, in our case 15% is the required rate of return, 12% is the growth, you have this simplification, you have this simple formula, it's called Gordon's dividend discount formula. If you plug these numbers, if you put 100 over here, which is the dividend for company A, 0.15 over here, 0.12 over here, you come to a price of 3,333. If you put 25 over here, 0.15, 0.12, you come to a price of 833 rupees. Both are the fair values of company A and company B by the DCF formula, by the intrinsic value formula. Too complicated, right? It's a lot of mathematics. Forget about it. Forget all about it. Simple thing. One company is paying you 100 rupees dividend, other company is paying you only 25 rupees dividend. That situation will continue to eternity because of the nature of business. Company A will always pay you 4 times the dividend of company B. Logically, company A should trade at 4 times the market price of company B, which is exactly the ratio. If you multiply 833 by 4, you get the number on top. And at these prices, ironically or logically, the dividend yield on both the stocks is 3%. Now, when we talk about, and this is something which I learned later in life. So, when I started investing, this thing was not clear to me. So, in the beginning, I would always look for cheap stocks, low price earning stocks and whatnot. So, Buffett keeps saying that buy companies with high return on equity, buy companies with high asset turnover ratios and all, with good amount of free cash flow. But he's never explained it like this. So one had to take him at face value, one had to go with what he was saying. Whereas when I actually put these numbers into the formula, the mathematical proof also came out. And as layperson, if we fall prey to this illusion that a 8 PE is cheap and a 30 PE is expensive, it's nothing to be ashamed of, because you tune to CNBC or you read any research report by a analyst, they will only talk about earning per share, they will only talk about growth. I am yet to come across many reports where they talk about payout ratios or the return on equity, incremental return on equity. So this, I think, is something similar to the optical illusions that we saw. Is again, I explained how the dividend payout in company A will always be 4 times the dividend payout in company B. So when we talk to people saying Unilever makes a lot of sense or Nestle is a good investment, people say, oh, these stocks are always expensive. Kuch sasta dikhao. Show us something which is cheaper. But somewhere there is a logic why some sectors and some companies command those high price earning ratios and why some sectors always have low multiples. There is a sound economic logic. It is not just sentiment or market fancy. This is the second part of it, what we discussed at Flame. When we talk about return on capital or return on equity, basically what we are talking about is how much money have shareholders put in the company, and for that how much profits the company is generating. This simple formula has been broken up in finance theory for analysis into this formula. So if you cancel out sales and total assets, you are left with net profit by net worth. It's the same formula. It's just been expanded into 3 categories. This is your gross profit margin. How much is your purchase price and how much is your selling price and what profit you make relative to sales. This is your net profit margin. This is your asset turnover ratio. Relative to your assets, how quickly are you able to sell your goods and services. And finally, this is your leverage. A combination of these 3 will give you your return on equity. If you have high margins, you get logically chances of getting a high return on equity are good. If you have high asset turnover ratio, again good for the business. Leverage, as such, it is good for return on equity, but it can also increase risk. So this is something which comes with risk, it's not risk free. How can you get a higher net profit margin? According to me, it can come only out of 2 things. Either you have pricing power of your goods and services, so you can charge higher to your customers, that is number 1, or if you don't have control on pricing, you have a huge cost advantage over your competitors. It can come out of either price or cost. This high asset turnover ratio can come out of 2 factors. One is either your sector is like that. So we discussed some service industries like let's say credit rating agencies or IT services or some consumer companies like FMCG companies, or it can even come out of your business model. A sector like hotels as such is capital intensive, but if you are just managing hotels on a contract basis, then the business model changes. Then your capital is not at stake, you just get the income from running that hotel. Or we saw a company like Club Mahindra where they take money in advance from the customers, that same money they use to fund their hotel properties. So this can be either the nature of the sector or it can be tweaked by a proper business model. So computers, for example, or mobile phones, as such it is capital intensive, but Apple computers, it outsources the entire manufacturing to Chinese companies, Foxconn and so on and so forth. They just focus on design and marketing. So their return on equity is much higher than the outsourced manufacturers of that product. So that is relevant here. So net, the thought that I want to leave you with today is P ratio is, end of the day, what is called a heuristic. It is a shortcut. It is not a scientific valuation tool. If you blindly use the price earning ratio, you are falling prey to that the table on the left hand side is longer than the one on the right. Thank you. So we have some time today, maybe 10-15 minutes, if there are any questions or if sure.
Trying to understand what you're saying, other than P ratio, you're talking about dividend payout.
Yes.
Which is the important factor.
Yes. Growth is important. How much earning is there is important. At the same time, return on equity and capital efficiency is also important, or how much payout is there. A company which does not generate any cash flow for shareholders or any free cash flow, a company which has to keep on reinvesting its profits into plant and machinery or inventory or something, is not as valuable a company as some other company which is.
Rajeev, you know what you said about FMCG companies. Isn't like for example Noida, isn't that also a similar business without the capital cost, and now they're just generating the toll every year? I mean, still, why isn't it reflecting in their results? I mean, they're not able to show better results quarterly. What is the reason?
So their results which have been coming out have been pretty good. In fact, the one which came out yesterday was also dramatically good. See, the bottom line is the EPS is not showing it. See, what according to me what is happening is there is a toll negotiation which is coming up in terms of hike. Most of the things which are there on the expense side for the company are non-cash items and are provisions.
So the overlay and all is not a.
Overlay is an estimate that they are saying they will have to spend in the future to relay the road. It's something like a sinking fund or a replacement. It's not a payment which is made, that is one. The tax amount that is shown, that is again a deferred tax liability which they are showing, which is not something which will go out of the bank balance of the company. So despite all this, month on month their debt keeps on going down, their revenue has gone up by close to 18% over last year. Their PBT itself has shot up dramatically. PBT is up maybe some 50-60%. So it's going exactly as it should.
So they're just trying to basically
See what they are, if there is a lot of profitability today, there will be demands for huge dividend payouts and toll hikes become difficult. This company has another period of maybe 2.5 years where debts are yet to be repaid and where banks will have some say on how profits are distributed. This higher tax provisions that they are making or this overlay that they are providing, they have already provided for 16 crores so far. Their estimate is that another 12 crores is to be provided over the next 6 quarters, 5 or 6 quarters, 5 quarters. So it's not a big amount considering what they have already provided in the past. It's an item of expenditure which will go away in the future. Tax provision, it's mostly deferred tax liability which is getting reflected. It's not a cash item of expenditure. So that will also taper off. The tax rate is in fact significantly higher than the highest tax rate which is there. So that is obviously not this.
Quarters they will show a big bump, or it will?
See, it's a stock where, according to me, a 2-year investment from this date onward. So maybe you would have bought it a year back or a couple of years back, but 2 more years of investment is required. Investment holding is required. Yes.
Doesn't Warren Buffett talk about not payment of dividends to conserve cash?
Warren Buffett has one standard for his for the companies where he invests, and he has one standard for his own company. So Berkshire Hathaway does not pay dividends. All his investee companies throw out a lot of cash. And Buffett has this standard for himself. He says that if I am holding $1 of cash of my shareholders, then I have this test. By holding that $1 with me, am I increasing the market value by more than 1? If the answer is yes, I will continue to hold it. If by holding $1, my market prices or market value is going up, let's say 80 cents, then I am better off paying that $1. So he is looking at whether he is adding more value or not. But this comparison, so Warren Buffett has 2 investee companies, for example. One is See's Candies and other is that railway company Burlington Northern Santa Fe. If you ask him which is a better business, I don't think he'll take even 5 seconds to answer. See's Candies is the better business in terms of investing.
What is the risk, Rajeev, in having a 100% portfolio of such cash generating companies? Because most of them happen to fall in similar sectors like FMCG.
Correct. So these things depend on the other things being equal. So if one company is paying out all its cash and is not growing at all, so if growth rate instead of 12 is 0 and the other company is keeping back cash and actually growing at a decent sum, then you will have different numbers coming in. There is no fixed answer to should you buy a FMCG company or should you buy a power utility company. You could lose money buying a FMCG company and you might make money in a power utility. I am not saying tomorrow morning look at your portfolio, throw out all the companies in manufacturing and buy only these sectors. I am not saying that. What I am saying is, when you are doing your calculation or when you are reviewing the stocks in your portfolio, do not stop at EPS and growth. And P. That's where 99% of the or 100% of the lay investors and 99% of professional analysts stop. I am saying go one step further, look at the payout ratio and the incremental return on equity also. That's all I am trying to say. Don't stop there. It's not a vote for one sector and vote against some other sector. In real life, you will not have these ideal circumstances. The same management is in both companies will grow at the same rate of return, both companies have the same EPS. All these things you will not get in real life. If you get such companies where growth rates are similar and payout in one is 100%, payout in another is 25%, one is available at 12 times earnings, other is available at 20 times earnings, you would be better off buying the 20 PE company.
In the historical context, can you give two examples of this illusion where means having identical ratios, just fair enough, just almost, and how just to give a more practical solution to this?
So sometime back I had made a presentation. It was titled "Where is the Proof?" It was given to this Rotary itself. So we had plotted different pairs of companies. One, this kind, the high cash flow kind of companies. The others were the manufacturing companies, low asset turnovers, low margins, no pricing power, and those kind of companies. Both companies from very reputable business houses, no problems with the management per se. And we saw the return to the investors over a period of, let's say, 15-20 years. We plotted the total return index. The difference was very dramatic. So unfortunately I don't have it on my device right now, but that was a very interesting slide to see. So in one case you would have a total return graph like this. The other one would be just way over the top. It's actually been the case, and for people who have been holding on some of these companies like Unilever or Nestle, it is proven by their investment track record and results.
See, let's take the example of say ITC.
ITC, yes.
Now ITC, they have a mix sort of a thing. I mean, they are building up huge cash reserves by holding back. I mean, they do pay dividends consistently, but their earnings, they are plowing back a lot and keeping it in reserves for, like for example, they have put 4,000 crores in the last 5-6 years on promotion of FMCG. Now they have deep pockets. For them, that 4,000 has no, has hardly made a dent in their profits. It made a dent, but their future profits can shoot up, according to my thinking, and it could become a Hindustan Lever type of company 2, 3, 4, 5 years from now. So then the valuation could then jump up from the present price to 400, 500, 500, 600.
That's a wonderful question, wonderful company to talk about, ITC. I have mixed feelings about this company. See, at one end, it's a survival thing for them. They are seeing a scenario where maybe 5 years from now, 10 years from now, 20 years from now, smoking goes out of favor with people in general. So it's a known fact that tobacco is harmful for people. You are having bans on gutka, there is ban on smoking in public places, many offices also have a no smoking policy. So for them, it's somewhere a question of survival. But from a pure economic point of view, their tobacco business is wonderful because it has high entry barriers. No one can come in since advertising is banned. It's an addictive product. It has phenomenally high margins, entirely free cash flow. Newer businesses, if you say FMCG, again reasonably good, the soaps and shampoo and ready to eat meals and biscuits and whatnot. But the other things, the hotels or paperboard and various other things that they are doing, those are not such great businesses. So somewhere there is a potential for shareholder wealth being destroyed by cash going to those areas. So Peter Lynch, a fund manager who was with Fidelity in the US, he has this thing that when a successful company with a very good track record diversifies into a new area, there is a change in its profitability profile. Earlier, 100% of its profits came from the successful line of business. After diversification, more than 100% of its profits come from the earlier line, because the newer lines start making losses. He has this interesting play on words. Diversification is spelled as Diversification. So diversification. He calls it diversification, WORSE. So it becomes worse after diversifying. So when one company in one line of business gets into something else, you have to be very careful as to whether they are actually creating value or destroying value going forward.
See, but now coming back again to ITC, now they are planning to get into dairy products. They feel, because you see they already have a distribution and a huge wholesale retail, reach, if I may say so. So they are also looking at the BD segment, which has got very low excise and or probably none. I was told that 80%, 70% of the smokers are in India.
BDs, I think, is restricted for small scale. I don't think they would be able to enter.
They may come out with a variant where the duties will be less, where like people have migrated from cycle to moped and from moped to motorbike. So there may be in rural India where the BDs are usually used, that those guys cannot afford the gold flake or something.
The duties on the entry level cigarettes, which were the unfiltered cigarettes, have been hiked up dramatically a few years back. So at the lower end, for a company like ITC to come out with a smoking product between BDs and the unfiltered cigarettes, according to me, that possibility has been closed out. Another thing you have to keep in mind is BD is a politically very sensitive thing, because it provides employment to a lot of people and so on and so forth. Allegedly some ministers are also into that space, and their interest is to keep out the cigarette manufacturers from poaching into their territory. So that apart, to come back to our topic of discussion, a company throwing out cash and a company hoarding cash and putting it into not so high return on equity businesses, look at two companies in the same sector. You have ITC at one end and you have VST at the other end. Look at the dividend profile, the cash payout profile of these two companies. Look at shareholder returns and various things. It's quite interesting comparing these two.
But VST is also owned by
VST,
ITC.
ITC has a 15-16% stake or maybe 20% stake, but they don't have management control. It's also owned by British American Tobacco, BAT Group.
Both companies are owned by
Management control of VST is with BAT rather than with ITC. In fact, ITC has been selling some shares of VST. Thank you very much.
Thank you, Rajeev.